Welcome, everybody. My name is Kristen Biermeyer. I'm the marketing manager for Wagner CPAs, and I am so happy to have you all join us today as we bring you up to date on the latest developments in auditing and accounting. This presentation is being recorded, and it will be emailed to you after today's event along with the slide deck. We will not be addressing questions during the presentation today, but if you do have questions about today's presentation, Kyle will be happy to follow up with you after the webinar. His contact information will be provided to you in the follow-up email as well as in the presentation today. Our presenter is Kyle Ager, a senior manager in Wagner CPA's Assurance Department. Kyle serves our nonprofit clients with their audits, reviews, and 990s. And with that, Kyle, I will turn it over to you.
Thank you so much. Welcome, everybody. Thank you for joining us. I hope you're all doing well. As Kristen mentioned, I really devoted my career so far to helping nonprofit clients. Based on the attendee list, I've worked with many of you over the years. I hope that you enjoyed today's presentation. I'd also just like to mention right at the beginning that some of the graphics and examples that I'm using have come from recent AICPA presentation, so I just wanted to give them credit for some of those that are included here. In this first section, we're going to go over some information and trends that are not exactly related to new standards or pronouncements. However, they certainly affect overall management of nonprofit organizations and accounting. So we'll talk about a few things, and the first is budgeting. With COVID funding ending, organizations are having to replace that income that they might have had the past couple of years with PPP loans or employee retention credits. And if that's not something that your organization has specifically thought of, just keep that in mind that with that funding drying up, that will need to be replaced by contributions or other program revenue. So far this year, there's been very strong investment return. The major indices are earning on average about 16% compared to last year, where they lost about 10%. So we're expecting to see some organizations with a lot of investments flipping from a net loss to a net income this year. And to our next point, some organizations have been recently generating net income through their investments. However, they've had losses from operations. On the next slide, I'm going to give a graphic to explain that further, but that's just something to keep an eye on. If your organization has a lot of investments, it might be showing a strong net income. However, you might be bleeding cash flows from your core operations. And it's okay to have those investments, but if your operations are suffering, it's something to keep in mind that you might need to be taking a draw from those investments rather than just having all the gains and earnings being retained within the account. It's no surprise that over the last year, interest rates and inflation have been on the rise. The Social Security Administration had a cost of living adjustment of about 8.7% in 2023. This percent is expected to be lower, closer to 4% in 2024. But something that you want to consider while you're doing your budgeting is that the price you paid for a service or a good over the last year or two might not be what you're going to be facing in the next over the next year, and just be sure to add adjustments for potentially some higher prices while you're going through the budgeting process. Interest rates are expected to drop through 2024 and 2025. The Wall Street Journal predicted a 1% drop by the end of 2024. Okay, here's that graphic I mentioned about income or loss from operations. You can see here that the organization has a solid change in net assets, but because they had such a large investment return, if we back that out, they actually had a sizable loss from their core operations. To calculate an income from operations, you'll want to back out investment return or any ancillary income or gains that your organization might have to give you a better picture of what's going on with your core operations. We'll take a look at some giving trends. Contributions were down in 2022 compared to 2021, according to Giving USA. They do an annual report on giving trends, and the 2023 report has not been made available yet. So this is the most recent information we have to work with. You probably aren't surprised by that fact. I think the nonprofit industry felt the decrease in contributions over the past couple of years. The three largest or highest categories that folks are giving to have been and continue to be religion, human services, and education. And lastly, foundation giving is down compared to 2021, and that's measured as the percentage of invested dollars being down, despite there actually being a small increase in the total number of dollars given. Slipped an extra slide there. With interest rates being up, it's a good idea to think about cash management and your cash reserve policy. Many organizations strive to have about 3 months of cash on hand, some as high as 6 or maybe a little bit more. And potentially, if you're sitting on more than 3 months of idle cash with these high interest rates right now, you might really be losing out, particularly with the higher inflation that we're facing. Some of the low risk investment options right now are earning more than 5%, whereas the average checking account is only earning 0.07%. So if you think about it, if your organization had $100,000 in idle cash, you could be earning about $5,000 or more during the year if you transferred those funds into a low risk investment. Whereas if they just sat in the checking account, you'd really only be earning about $70. This really hasn't been an issue for the past few years as the rates have been so low, but with the rising interest rates, it's really something to keep an eye on. We encourage you to work with your banker to consider what investment options might be the best fit for your organization. I have a few listed there. There's CDs, money markets, treasury bills, and this graphic here came from NerdWallet with some rates, really attractive rates for CDs. You will notice in the 3 and the 5 year amounts for the rates that those are starting to dip, and that corresponds with what I mentioned about potentially the interest rates starting to go down in 2024 and 2025. Just a couple other topics random things to go over is mergers being one. Mergers have been increasing in the nonprofit industry for a few reasons. The decrease in contributions that we talked about, staffing problems, which are affecting all organizations, and baby boomer retirement at the executive director level are all factors that are leading to an increased number of mergers taking place. If that's something that your organization is considering, make sure you're doing your due diligence on whether both organizations are a good fit and that all the legal requirements have been met. We're just on the other side of Giving Tuesday, and you probably saw some social media fundraisers going on. These are becoming more prevalent in addition to AI fundraising, where AI is being used to identify donors and persuade them to give. So these are things that you may already be doing, but we're seeing a lot more of it in the nonprofit industry. Cryptocurrency donations are also becoming much more prevalent. There's a number of ways that your organization can accept cryptocurrency. You can receive them through an intermediary nonprofit organization. You can have a donation processor like Giving Block, which I have the little graphic on the screen, or you can even embed that right into your website. That's by far the least common so far. Most organizations that receive cryptocurrency are choosing to convert that right away into cash. But there's no reason that your organization couldn't choose to keep the cryptocurrency if it wanted. There are some tax implications with receiving cryptocurrency. Right now, those are being treated as a non-cash gift. Any donors that are giving more than $5,000 need to fill out Form 8283 with the IRS. And the donation of crypto is a non-taxable event for the donors. So that's very attractive for donors as unrealized gains are not recognized for them. Again, with the rising interest rates, promises to give are something that might deserve a little bit of extra thought this year. Many organizations have been using the same discount rate for a handful of years now, and that might have been okay with the lower interest rates. However, this should be reconsidered if you have any new significant long-term promises to give this year. And I'll also note that unless you're following the fair value method, which most organizations aren't doing, the discount rate is not changed after the initial discount is set. This is a snip from the Treasury's website where they list interest rates for various periods for each day of the year. This might be a starting point for you if you're looking to set a discount rate for your promises to give, or maybe even an interest rate for the leases that you might be looking at. We'll mention underwater endowments real quick. Due to the fluctuations in the investments and market the last few years, some endowments that your organizations might have might be underwater, which would mean that the fair value of those funds is less than the original donor gift. If that has taken place, you'll need to disclose the fair value of the fund, the original gift amount, and then the difference, which is the amount that would be underwater. Hopefully this year with the strong investment return, there won't be many of these left, but definitely something to keep your eye on. We're not going to talk a lot about compliance today, but a couple of things that I will note is that there's an exposure draft on the Yellow Book for government auditing standards right now. One of the key principles in that is that there's an emphasis on quality management of audits, and that scalability, we're going to talk about that term a few times today, that they are trying to make these standards applicable to large and small organizations that are performing audits. There's also some revisions to the uniform guidance being proposed. One of the major ones is an increase in the threshold from $750,000 to $1 million. Every year we have clients that are right around that $750,000 mark, and we're trying to debate whether or not the single audit will be applicable to them. This will definitely help those organizations out with that bump. Certainly organizations will have funding that'll be right around $1 million each year, but we're still happy to have that bump potentially. There's also a provision for an increase from $5,000 to $10,000 for determining what items may need to be considered as equipment rather than expense. And they're looking to raise the de minimis rate from 10 to 15% for indirect costs, which will help smaller organizations that haven't set their own cost rates. Next, we're going to talk about some of the new auditing standards that are applicable soon or right now, and what effect that might have on your audits. The first is auditing accounting estimates and related disclosures. This standard comes into effect for December 31st year ends and addresses auditors' responsibilities for accounting estimates and disclosures. There's a lot of different accounting estimates out there, and they are used when monetary amounts cannot be directly observed, and include things like functional allocation of expenses, useful lives, and allowances for receivables. The decree to which these estimates are subject to uncertainty will affect ultimately the procedures that are applied during the audit. For estimates where the uncertainty is low, complexity and subjectivity are also low, you'll likely see that the audit procedures will not be as extensive. On the contrary, when uncertainty, complexity, and subjectivity are high, we're expecting that there'll likely be more procedures related to these estimates. So really, what can you expect from your perspective? You'll likely notice that there'll be more procedures around gaining an understanding of your entity and processes related to significant estimates. If your organization works with a specialist to develop estimates, which is common with things like benefit plans, there'll be the new standard will require increased collaboration between the auditor and the specialist to gain an understanding of how those estimates were developed. And as I mentioned, you'll see that the procedures will be dependent upon the complexity of the estimates that you have. The other big standard is the risk assessment standard, and that also comes into effect this year. The new standard does not fundamentally change the risk assessment process. However, it does enhance certain information and intends to enhance audit quality. The new standard includes guidance on scalability, again, to make the standard relevant to both larger and smaller organizations, as well as organizations that are more and less complex. And it also includes guidance to help modernize the risk assessment processes, taking into consideration that many of the processes are becoming more electronic and involving more IT and those sorts of things. Excuse me. One of the key provisions with the new standard is a new definition for a significant risk, and that is an identified risk where the inherent risk is closer to the upper end of the spectrum, as you can see on that little graphic that I have there, based on the factors where the likelihood and magnitude could lead to a potential misstatement occurring. There's also other risks that are required to be treated as significant, and you've likely seen communications about these in the past from your auditors, involving things like override of controls, revenue recognition, and also certain related party transactions. The risk assessment standard is going to require the auditor to evaluate certain controls and make sure that they've been implemented. There's a new requirement that we separately assess inherent risk and control risk. Those two components collectively make up the risk of material misstatement. And also a stand back requirement, which requires auditors to stop and reflect on the completeness of their risk assessment procedures. There's also some guidance on maintaining professional skepticism. So what does this mean for you? Management should expect to see more significance placed on gaining an understanding of controls related to risk, including IT, and as a result, procedures that are tailored to those risks. As I mentioned, there may be a shift in emphasis away from areas that are less risky and more towards higher risk. The trainings that we've been going to often are using the example of property and equipment. Balances may be large for property and equipment, but oftentimes they aren't changing significantly. And that might be an area then that we consider to be of lower risk, and maybe there'll be less procedures involving that area, even though there's a really high dollar amount associated with them. The last auditing standard we'll talk about just really quick is the non-compliance with laws and regulations, which is abbreviated to NOCLR. The update is going to require the auditor to inquire of the predecessor auditor when they're taking on a new audit regarding non-compliance with laws and regulations, and assist the auditor then in determining whether or not to accept the engagement if any of that information comes up. So now we're going to talk about some pending ASUs. They have not been adopted yet, but they're potentially coming down the pike. The first one is the accounting for and disclosures for crypto assets. Currently, these are recorded at their historic cost on the balance sheet, and the proposal is to move them to fair value. The amendments on this proposal, if a crypto asset meets all the following criteria, would be subject to this disclosure. But all the major cryptocurrencies you might be familiar with are likely to fall underneath this standard. Along with this proposal, an organization would be required to expense any cost to acquire crypto assets, which would be new. And there's some updated presentation requirements as well. So the crypto assets would then be shown separate from other intangibles on the statement of financial position. Gains or losses from them would be again shown separately on the statement of activities. And any crypto assets that were received as contributions would be included as operating activities on the statement of cash flows. Another proposal is for improvements to income tax disclosures. The goal here is to improve transparency and the usefulness of income tax disclosures. And they plan to do that by having amounts that you organization might pay for taxes split between federal, state, and foreign, as well as disclosing any jurisdictions receiving more than 5% of your taxes paid. This is really only going to be relevant for organizations that have unrelated business income. So now we'll jump into some new accounting standards and an update on some information with the leases that we dealt with during the current year. As a reminder, the lease standard came into effect last year, and most organizations have had to include their leases on the statement of financial position as right of use assets and lease liabilities. Last year, we looked at some of the potential difficulties with the lease standard, and we'll look back at these now and see kind of what came up during the year. There was a concern that the new lease standard and the assets and liabilities might affect contractual agreements or loan covenants. The good news is that we did not run into any major concerns this year with state or county funding sources with these changes, nor have we run into any problems with banks or lending institutions when they're calculating their ratios or covenants. Most of the bankers are simply excluding these assets and liabilities from their calculations and simply doing them the way they had in years past. Remeasurements and the process for making remeasurements when leases change is something that we'll talk about in just a few slides. Segregating between lease and non-lease components was a concern last year. However, we found that most organizations are choosing to not separate between the lease and non-lease components for ease. And that really comes into effect if you're, for example, had a space lease and the lease had a provision for common area maintenance or something like that. Again, most organizations are choosing not to split out that extra component and instead keep all the costs together and measure the asset just once with all those different components included. The incremental borrowing rate was something that organizations were concerned about having to calculate. However, we found that most organizations are using the risk-free rate, and we'll discuss that again further in just a couple of slides. Transition and disclosures. Most organizations have adopted the new standard at this point and have found that they have some new policies included in their financial statements, as well as a substantial new footnote. Excuse me. And lastly, the need for software. So most organizations that we serve are using LeaseCrunch, which has been working very well for them. Some organizations are choosing to do the calculations on their own spreadsheets or using some templates that they found online. It's certainly okay to do that. However, I just want to point out that, as I'm sure they're aware, with those templates, anytime a formula gets goofed up or a number's off slightly, that can affect the whole calculation. So just something to be real careful when you're doing those calculations in Excel. All right, as I mentioned, the discount rate for leases is something that caused some concern last year. There's been an update which allows organizations to choose whether or not they'd like to use the risk-free rate by class of underlying assets whereas previously organizations had to choose to do that as a all or nothing provision. So why this might matter is organizations that have maybe a new really significant lease might want to use the incremental borrowing rate, which could be lower than the risk-free rate. And then that would result in smaller assets and liabilities on their statement of financial position. Whereas for smaller things, maybe like a copier lease, they might just choose to use the risk-free rate. So it does offer some flexibility there. Another update relates to common control lease arrangements or related party leases. Nonprofits that are not conduit bond obligors can use the terms and conditions of an agreement to determine whether or not a lease exists, and as well as the classification, and this can be applied on a lease-by-lease basis. Excuse me. There were some complaints that under the guidance that the lease standard would add a lot of complexity and cost for organizations that had these related party leases. For example, if there was a parent subsidiary where there was a space lease, the lease would have to be included as a right of use asset and lease liability on the statement of financial position, which takes effort and cost, but then would ultimately be eliminated in consolidation. So this provision allows organizations to document any previously unwritten leases. So it's kind of like a get out of jail free card, and then choose not to have to report those throughout that consolidation process. And it's important to note that if there's no written agreements, that the organizations must follow ASC 842 and include those. So it's a really good idea to get those agreements documented so that you can treat them as simply as makes sense for your organization. There's also an update for leasehold improvements with these related party agreements where the improvement needs to be amortized over the full useful life for the control group, regardless of the lease term. So for example, if there was an improvement that was expected to last for 10 years, however, the lease is only for 5, you'd still amortize the improvement over 10 years. Whereas if the parties were unrelated, you'd amortize over the shorter of the lease term or the expected life. So that's definitely a change there. And also, if the lessee no longer controls that asset, they need to treat that as a transfer between the the entities as an adjustment to net assets. With the lease modifications that may have happened through the year, anytime a contract changes, you'll need to consider what happened and why. What we typically see is there might be a change in scope where an asset is added or removed. Maybe the payment has changed or the lease term has been extended or shortened. When these sorts of events happen, the organization is going to have to consider whether or not there still is a lease and whether or not there was a contract modification that would require remeasurement or treatment as a separate contract. So if the change in contract granted additional rights, meaning that maybe there was more square footage as I have here, and the increase in payment is equivalent to the standalone price for a separate lease, you'll treat that as a separate contract. And if you're working with us with Lease Crunch, we just entered that in as a new lease. However, in other circumstances where you're changing the term of the lease, fully or partially terminating it, or changing the price, or you're adding additional assets, but the price is not equivalent with the standalone price, we'll treat that as a lease modification instead. And if that happens, we'll remeasure the lease liability and the right of use asset, and you'll have new amounts on your statement of financial position. So this is really an important thing to consider this year and annually, what might have changed with your leases, and let your auditors know so that they can either revise those calculations or potentially help with new assets or liabilities as separate contracts. And lastly, related to these leases, if there is impairment of a leased asset, what you'll do is you'll reduce that right of use asset and credit or debit a gain or a loss account depending on the transaction. The last standard that I think that we're talking about here is the CECL standard for credit losses. This was effective January 1st, and what it does is it takes the old GAAP requiring an incurred loss methodology and replaces it with a new guidance where all expected credit losses over the contractual term of the financial assets are recognized initially. And it also broadens the information that can be used to include forward-looking forecasts to help with those calculations. The scope of this standard includes all of your trade receivables and contract assets, as well as your loans and notes receivables. But specifically, it excludes promises to give, as well as loans and receivables under related party agreements. So as you can see there, this is really covering things like your program revenues, your tuitions, your membership dues, those types of non-exchange transactions that you have. So to implement this standard, the first step is going to be to pool your receivables that have similar characteristics of risk. And the next slide, we're going to go over a few of those. And then you'll adjust your historical loss percentages for current conditions or forecasts. And if required, you'll revert to historical loss for future periods where you can't forecast. So as an example, let's just say that an organization has a historic loss rate of about 3%. However, excuse me, due to rising interest rates and inflation, you might think that losses might increase just a little bit. So as a result, you might choose to increase that rate to, let's say, 5%. Excuse me, I have just a little bit of a tickle in my throat. And after applying those new rates, you'll determine a new allowance and update the allowance accordingly. As you can see, there's a number of different ways that your organization can categorize the different receivables that you might have. But the most common, I believe, are going to be the first four: financial asset type, term, size, and geographic location. However, your organization certainly can consider different characteristics that might be more useful for your purposes. I wanted to point out that CECL's effect on short-term receivables is not likely to expect it to change significantly from your current practices. However, you most likely will be seeing some revisions or updates to your significant accounting policies for receivables this year during your financial statement prep. Lastly, we're just going to take a quick look at some updates for COVID funding. You may have seen recently that the IRS recently put a stop on employee retention credit filings, and that's due to the aggressive marketing and potentially ineligible applicants. You might have seen advertisements on TV or radio saying that all organizations are able to receive these credits, and really not all of them were able to. So they're taking a closer look at that, and the stop is going through at least this year, the end of this year, and we'll see what happens over the next few weeks and months. Provider relief funds also ended in June of this year, and there'll be no further payments made under this program. However, your organization will still continue to report on payments received as we move forward here. And I'll just scroll to the next slide that shows how those payments are then being reported. And that's really something to keep an eye on if your organization has received those funds. But just important to note that the payments have now ended for the provider relief funding. That's really all I had to share with you guys today. I apologize a little bit for the coughing that I had there and the trouble with my voice, but I hope that you learned something through the presentation. And as Kristen mentioned, I'd be more than happy to follow up with you if you have any questions on the content that I shared today, or if there's anything that we can specifically do to help you implement any of the new standards, or just any general accounting advice.
Thank you, Kyle, for sharing your expertise, and thank you everybody for joining us today. We hope you found this information, this update helpful. We have a fantastic lineup of trainings for nonprofits in the works for 2024, and that will be posted to our website soon. So if you're subscribed to our email list, you'll get those updates in your inbox. Otherwise, reach out to me or go to our website to subscribe to our emails and get those updates. It's wagnercpas.com, and you can check on those under upcoming events. We look forward to having you all join us again in the new year. Thanks, and have a wonderful day.